Hello and welcome to NDTV Profit. I am Vishwanath Nair and you're joining us on the special conversation that we're having with Mr. Neelkanth Mishra, Chief Economist at Axis Bank. Today, of course, Neelkanth and his team have released a detailed report on the Indian economy as well as the kind of global headwinds that are facing the world. We have the report in front of us, of course. Neelkanth, I wanted to welcome you to this conversation. I wanted to start off this conversation with this bit of this GDP projection where you're talking about that there's expected to be further upgrades going ahead. The RBI has already made its upgrade from 6.5 to 7% for FY24. What is your estimation looking like?
Thank you for having me here, Vishwanath. See, in GDP growth, the biggest shift that has happened in the last, I would say 2-3 years before the pandemic, was that trend growth assumptions had been brought down. In the 2007 to 12 period, India's GDP growth was widely expected to hold at about 8%. That was considered trend growth, and that if you were growing above that, it would cause inflation. If you're growing below that, it would be because of problems. Now, what happened in the years after that, as the large corporates deleveraged, as the real estate cycle went through an extended downturn, is that you saw trend growth assumptions being brought down. And during the pandemic and after the pandemic, most people thought that what was 6.5% growth pre-pandemic could actually slow down to even below 6%. Now what we are seeing is that with the revival in the real estate market, so all the accounts, on all accounts, the capital investment cycle, the pace at which capital input is growing is now surprising on the upside. And this suggests that perhaps the correction downward from 8% to 6.5% and even lower was perhaps overdone, and we start to see 7% plus trend growth assumptions. What does that mean? It means that the level of growth above which inflation starts to pick up then goes up, in the sense that if trend growth is 7, then if you're growing at 7, then there shouldn't be very strong inflationary pressures. And the second is, of course, that in terms of the pace at which capital investment needs to come back. So as this becomes consensus, meaning that boards of various large companies also start factoring in stronger growth, then the capital investment that they need to commit to also starts to get brought forward, and the nature of India's growth trajectory also becomes much healthier. So both of these are, I think, important assessments that we bring out in this report.
Right. Neelkanth, one point that you bring up in your report, and this is something that the RBI governor also pointed out when the monetary policy announcement was being made, was with regard to the uncertainty on the global front. And that seems to be still weighing heavy on the RBI's mind, as well as I can see that the Axis Bank's research team is also looking at it very closely. But if you could just take us through as to what is it that you're expecting going ahead, because things at this point in time are a little bit status quo.
Yeah, status quo. In fact, most people think that things are improving. In fact, the consensus seems to have very quickly veered towards a soft landing. So now almost every global house today expects a soft landing in the US, which means that there is no need for a recession in the US, for inflation to come down and for rates to start getting cut. So what are we worried about? So I think the RBI's concerns would be more, I would say, based on what they see in terms of capital flows, in terms of behavior of various exporters and importers and people who deploy capital. Ours is based on some very important data points. The one is that the reason that 2023 did not see a US recession was because the fiscal deficit in the US went up quite sharply. So it was supposed to be $1 trillion. It turned out to be $2 trillion. So if you see a 3.7% of GDP expansion in fiscal deficit in a country in 1 year, it means that a recession becomes very harder to expect. Now, what is striking to me, and I would say to some extent alarming, that I see very little discussion of this in the media and even in financial market commentary. And perhaps this is a very emerging market kind of analysis, meaning that the exorbitant privilege that the developed markets have had, especially the US, and also the fact that so far they've actually had some semblance of fiscal discipline, is something that has made people not track these things very regularly. Now, what does this mean? What this means is that when this fiscal stimulus is no longer there, remember that an increase in fiscal deficit is a fiscal stimulus. If the fiscal deficit remains flat at, say, 7.5% of GDP, it will have no impact on growth. So if you're not increasing your fiscal deficit in FY24, the fiscal year ending 30th September 2024, then there is likely to be a recession because the monetary conditions are still tight and tightening. The second implication of this is that this is a pro-cyclical fiscal deficit in the sense that you are having 7.5% plus fiscal deficit with 3.5% unemployment. So if unemployment starts to go up, then the fiscal deficit expands further. Remember that theory says that fiscal deficits need to be counter-cyclical. And the most important point here is that you are seeing now a debt to GDP trajectory which becomes even more unsustainable. So as per the Congressional Budget Office's forecasts, they were expecting 125% of GDP by 2033. It's currently about 100%. If you build in the slippage that we saw in FY23, and there are enough reasons to believe that that slippage will persist, just on that basis, the debt to GDP a decade later can be 150% of GDP. The only way you can sustain something like that is by financial repression, meaning that you need to have structurally higher inflation in the US than the 2% that they've been used to. And that's something that means a very dramatically different environment for global financial markets. The risk-free rate then becomes much higher. At some point, the current quantitative tightening that the Fed is doing will have to reverse. And for the Fed to find a justifiable excuse to turn from QT to QE will mean that there'll need to be a speed bump or some sort of growth accident or a financial market accident that allows them the leeway or that permits them to start turning from QT to QE without destroying their own inflation fighting credentials.
In your estimation, are you building in this kind of financial sector accident that you're describing? Are you building that into your expectations going ahead?
So we are building in a growth slowdown. So which is why FY25 we have India at 6.5, though, and that means below trend growth. So the reason is primarily what I think is going to be a sharp external slowdown. Predicting accidents is generally Muck's game in the sense that they happen when they have to, and you can't really build a scenario around them. In the sense that, as per an important paper by Ben Bernanke in 2000, I think a few years back, about the 2008-9 crisis, his assessment was that if financial market accidents had not happened, then even the 2008-2009 recession in the US may actually have not been a recession, it was just a growth slowdown. Basically that they could have brought down the real estate bubble or deflated it without causing a recession. So financial accidents are hard to predict. At this stage, given how well capitalized most banks are, how tightly regulated they are, how tightly regulated insurance companies are, it is very hard to imagine that something can break very quickly there. But at the same time, there are many derivatives, there are very large hedge funds, there are large countries which have sustained high debt to GDP with the assumption or under the underlying assumption that the interest rates will remain low forever. And in the current fiscal path that the US has adopted, remember that after the financial crisis, they had taken a tight fiscal, loose monetary approach, and now they've taken a loose fiscal, tight monetary approach. So in this new environment, I think debt to GDP sustainability for any country which has high debt levels becomes very challenging. So things can break apart on several dimensions, but we are not expecting that in our forecast.
Right. Not to forget that just this year we had bank failures in the U.S. as well. So, financial sector accidents, as you were saying. But let's move on to the emerging sector, especially India. This movement from QT to QE that you were describing earlier, I wanted to get a sense as to as the global economy goes through this journey, how do emerging markets like India deal with that kind of the kind of fallout that may happen in the global economy?
Yeah, that's a very important question. I mean, we are finally most interested in what's happening in India and what the global turmoil can mean for us. So one big change is that if you have risk-free rates, which is the US 10-year bond yield, sticking above 4%, so from being in the 2 to 2.5% range for most of the last decade, the capital flows to emerging markets will slow down. So already asset allocators are asking the question, if I'm getting 4.5% yield or 5% yield in US Treasuries, if you add on a bit of more risk, you're getting 7-8% returns on reasonably safe government bonds in the US, then why should I put any money into emerging markets at all? So in my global roadshow, when I met investors in the US, UK, and Singapore, almost every emerging market fund was either seeing outflows or was afraid they would see outflows. And so that means that, and given how much of the foreign participation in Indian public equities is through Asia and EM funds, that is a very worrying sign. So till the time that the Fed does not restart QE, remember that after the incident you mentioned, where bank failures in March meant that the Fed very quickly started expanding its balance sheet, the point that till that happens, or so once the Fed starts expanding its balance sheet, you will see, I think, a return of flows. But in the run-up to that accident, as we drive towards that speed bump, the outflows from EM funds may actually intensify. So I would remain cautious on the flow of funds. So we have seen in the last, I think, month or so, as rate cut expectations have built up in the US market, that there's been a bit of easing, meaning that portfolio investors are starting to become a bit more venturesome and a bit more warm towards emerging market assets. But as I said earlier, in a shrinking dollar environment, is more and more dollars are sucked out by the US government and the US economy. I think flows to EMs will remain quite bleak. And as the US goes into recession, or because of fear of accidents, financial conditions tighten, we could actually see even stronger outflows. But once the Fed has started easing, just like what happened after March, April, you could see several months of very strong inflows.
Just to take a few points that he made, of course, the expectation that India is going to grow faster at about 7%. That's the FY24 estimate that Axis Bank has internally. Of course, that matches the RBI's estimate as well. He's also, of course, talking about the fact that as companies start building in this sort of higher growth estimates into their plans, then of course that pushes up capex spending, private capex spending as well. He's also highlighted the sort of slower issues that are coming up within the global economy, especially the US. He's expecting a financial sector accident to sort of propel any kind of change within the Fed's monetary tightening or quantitative tightening phase that the US Federal Reserve is going through right now. Of course, what that means for Indian or other emerging market economies is that eventually you will start seeing some kind of outflows within emerging market funds. So that becomes an issue for emerging markets like India.